So thanks a lot for joining us again today for another webinar organized by Princeton for everyone worldwide. We're very happy to have John Campbell with us from Harvard and Tarun Ramadorai from Imperial College in London. And they will talk about personal finance and their new book, Fixed. Hi, John. Hi, Tarun.
Hello,
Hi,
thank you
Markus.
for having us.
Thanks.
It's great to have you both. And let's talk about your book. So here's the cover. So it's Why is the Personal Finance Broken? And you will also provide a solution, how to make it work for everyone, not just for the wealthy. And it's an interesting, important book, how to design the financial system in such a way that it's beneficial for everybody. Let me give a few opening remarks and then we pass it on to everybody of you. So one philosophy could be free to choose any investments you can choose, but of course it has the advantage or has disadvantage that other people can take advantage of the less financial literate. And so we have to take care of this. So how should we choose that? So one is to say we should actually limit the choice set. So people can only choose investment products, insurance products out of a limited set of possibilities. Or they can actually, they have to consult some experts or the regulators decide how to design the choice set. And that's a little bit similar what we have in the FDA in the medical field, where there's an analogy going on. So you requires, in order to make the right choice, if you have a huge big choice set, you have to have expertise, you have to have information, but there might be information and cognitive overload. So it's an argument we should have a simpler system. And, you have to be very rational. And most of us, suffer from behavioral biases. And that's also a big challenge. And of course, if the choice set is very large, we need a lot of advice, and this will cause some fees, which we have to pay to the financial sector. So designing this financial system such that it works for everybody, also for the less wealthy, I think is a big challenge. The other challenge I think I would like to raise essentially is that what we have often is some staggered participation. So initially, when some new product comes along, very few people can participate, and then they push up the price of these products cause high capital gains. And once you're in bubble territory, you push it onto the retail investors. So there's this saying, from Joseph Kennedy, the father of JFK, when the Shushan boy starts giving stock market tips, it's time to get out of the market, showing that, initially it is the case that, you buy stocks, you push it up, and then it gets very high. And then when the participation is very broad, then actually it's time to get out because the people getting in at the end are the less financially literate people. And that raises the question concretely, should retail investors be allowed to put their 401k investments or retirement savings into crypto at the moment, or private credit or private equity, which seems to be at a very high price at the moment? People who got in very early on, they will benefit from pushing it up and then get out of it at a very high price. And how should we handle with that? Or how should there be a restriction to what extent you can put your retirement savings into these more highly speculative, illiquid assets? So let me leave it at that. So we are looking forward to get a peek into the new book, which is available already now, just came out last week. It's my understanding on personal finance and how to make it work for everybody worldwide. Thanks again, John and Tarun.
Thanks, Markus. Well, thank you very much again for inviting us on. It's a real pleasure to be here. I mean, especially having seen so many of these wonderful talks before. And so let me sort of get into it by starting out by telling you a little bit more about why we decided to write this book in the first place, and why we decided to write it at the moment, right now. So we start the book and also actually end the book with the stories of these five people. And these are anecdotes, but we really believe that this is a far more systemic issue. So ordinary people routinely have really terrible encounters with the personal finance system. So I can sort of summarize a few of these stories, which will give you an insight into how bad these encounters can actually be. So we start off with the example of Renata Keynes, who is in the US, goes out there, tries to find a college, finds one to try to become a teacher at the age of 17, has very little understanding of the fact that when she takes on an enormous amount of student debt, that the debt has to be paid off at some stage at an interest rate that is pretty high. She then finds the cost unmanageable, moves to New York, makes that cost even more unmanageable because, of course, the cost of living is particularly high in New York. Does a succession of odd jobs, really striving to get the education that she wants. And 10 years later, at the age of 26 or 27, she finds herself back in Boston with no degree and saddled with $65,000 of debt. Another story we tell is George Maddox, who was a plant manager at Enron, invests his entire retirement savings, has a really big nest egg of $1.3 million in the US, invests all of it in Enron. This is a classic finance mistake, which is being completely undiversified, has no idea that the bankruptcy is coming, but of course, as we now know, it did, and then has to end up moving out to a sort of ramshackle home in Texas with his wife and mows lawns for a living to try to really make ends meet at that stage. We also tell the story of Ruth Putnam, who tries to retire on money market interest because she is really terrified of stocks. She basically goes out there, buys, bonds and certificates of deposit, and then as interest rates decline, finds her income dwindling substantially and starts to sell off her priceless China collection piece by piece. This has enormous emotional value for her. Now, the book takes an explicitly international perspective. And so, as we say in the book, the US has no monopoly on stories of this nature. We tell two stories of mis-selling. One about Simon Shipley, who was for years sold payment protection insurance for a mortgage he takes on, as well as 3 other loans. This is bundled. He doesn't even know he's purchasing it. As it happens, many years after the fact, after he keeps paying it, he realizes that he would have been ineligible to claim anyway on this payment protection insurance because of the fact that he had a pre-existing health condition. He does get some remuneration because there's a class action suit that the Financial Conduct Authority actually pushes through, but there are many others in his position that are not compensated. And we quote, and he says he's amazed at how long this was allowed to go on. Another story from India is from the unit-linked insurance plan scandal, and in this particular case, Virendra Pal Kapoor is sold bundled insurance product that's supposed to be an asset management product, or at least that's what he's told by the state-owned bank that he sold the product by. 5 years later, 99.5% of his initial investment is gone in expensive premiums. And, as he keeps trying to find information about this through the journey, there's constant obfuscation. He has to take them to court, gets a high court judgment in his favor. And as we speak, the high court judgment is being appealed by the provider. So, these are stories where you kind of look at these stories and you think, gosh, that's pretty terrible. And then you might well imagine that the level of income that you have also determines how awful these stories might be for you, because obviously you could have your entire retirement savings nest egg wiped out. You could have situations where, an outlay for an asset management product is basically, again, wiped out in bundled insurance. And these things can be tolerated by people who are wealthy, but can be extremely material for people who have lower wealth levels. Now, these problems, we make the argument in the paper, are not just anecdotal problems, they are systemic problems. They are systemic problems because they're incredibly widespread. These stories are not just, one-off.
Where are we trying to get to? What's the ultimate vision? And this is the last chapter called We Can Do Better. And we argue that we should try to design a personal finance system that follows 4 very simple principles. Now, I know they sound a little bit like 4 of Disney's 7 dwarfs, simple, cheap, safe, and easy. But that is the idea. If you make products simple, they will be easy for people to use. People will be less likely to make mistakes, so they'll be safer. And people will be able to shop for them, so they'll be cheaper. So there's an interaction between these things. What we'd like to do is design a set of products that we call the starter kit for personal finance. And we make the analogy with the sporting equipment that you should have before you even start playing a game in order to be safe and competitive. And in each category of financial products, we think that the firms active in that segment of the industry should be required to offer starter kit products. Of course, they can offer other products too, but they must offer these. And the design of these products should be standardized with price structures that people the customers can understand so they can shop on price. And furthermore, they can manage them easily after they've purchased them. There may be some cases where a product is so important that we should require people to choose one, but that will not always be the case. Finally, what might be some examples? Well, we've got, the chapter is long. There's a lot of details. I'm not going to go into it all. I know we're short of time, but here are some examples. Think about simple transactions accounts. At the moment, people get very confused because they don't understand interest. And so they think it's a free checking account, ignoring the fact that it's not paying you interest. That is, in fact, the fee, but that fee is hidden. So we think transactions cost accounts should pay money market interest, but then subtract explicit fees so that people understand what they're paying for what they get. We've also learned, I think, that ordinary people find interest rates, even nicely standardized rates like APRs, surprisingly hard to follow. So we think that type of disclosure should be complemented by simple scenarios in which the dollar costs can be quoted. Lines of credit, we can work on those. We think that the key there is to avoid these sort of tripwire charges where a small overdraft triggers a big fee, or being late one day triggers a big fee. The fees should be continuous. And we also think credit should not be linked to spending as with buy now, pay later. It should be linked to the income that you're going to need to repay the debt. So paycheck advance, we're much more in favor of. Mortgages, there shouldn't be teaser rates on ARMs, and there shouldn't be points on fixed rate mortgages. Those are both traps and very confusing. Ideally, we'd like to see auto refinancing, but the low-hanging fruit is just get rid of teaser rates and points. We talk about assumability and portability. That's related to the lock-in problem that we've had recently in this country. That's a bit of a digression. Insurance companies, we need to ensure that they disclose information about their claims and their payouts. That's very important if people are going to shop on quality in insurance. Retirement accounts. We have this confusing, abundance of riches, a profusion of accounts, right? We've got 401ks, IRAs, traditional, Roth, 429s, ABLE accounts. Now we have Trump accounts. They keep multiplying. But the profusion leads to confusion. And we'd like to see a single retirement account with automatic enrollment at the date of first employment. So these are some of the ideas. There's others in the chapter, but this should give you the idea. And, these problems are serious, not only because of the consequences for individuals in their lives, the stories we started with, but also because the unpopularity of finance bleeds over into unpopularity of the market economy itself, and a loss of faith in the institutions that we depend on to operate the market economy. So we think you cannot neglect these problems, and it's time to start taking some action. One thing we're really hoping, and appearing on Markus's Academy will surely help, but we're really hoping that this book doesn't get pigeonholed in the personal finance section of the bookshop, where there's lots of personal advice, and it's often, good advice, but it's very niche. And we think this is a much bigger issue and should be framed in a different way, and that the book needs to be in a different part of the bookshop.
Big societal elements rather than purely how to invest as an individual.
Yeah, no, I mean, absolutely. Let me just add to that and say that, look, I mean, I think there's a sort of a telling in which personal finance is a self-help issue. And so everybody is sort of encouraged to go out there and get a bit of education and do this stuff. But I mean, I think our worry is that with so many people coming into the middle class and their first experience of the financial system potentially being one in which they're getting ripped off, is immediately something where, and then plus the cross subsidies where, you can sort of see that the rich are operating in a very different way than the middle classes or the poor. All of that together just really starts to destroy trust very quickly in terms of the people's personal experiences with the financial system being the touch point. And that's kind of really the bleeding edge of this issue in some sense from a financial markets perspective. And we really think that that's quite important.